Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about, see what people are sharing on X. It's going to be wealth, financial, or commodity related, as that's what I focus on. Wealth building is associated with commodities because I think that's the best value in the market right now, one of the best values. So we're going to dive in here. I'm going to give you my financial opinions. And we're going to start with finding me at finding_finance if you want to follow me. And you can join our community at finding-value.com. We also have a discount going on. Use the word September in the discount code and get 50% off the first month to try it out if you'd like. So, Rivian CEO says, I think the reality of buying a combustion powered vehicle is sort of like building a horse barn in 1910. Imagine buying a Chevy Suburban in 2030. What are you going to do with that in 10 years? Gas stations will be slowly disappearing. It's just weird. And I hope that's the case, guys. I really do. I'm a oil bull at the moment, but I don't like going to get gas at the gas station. I don't like changing oil, doing all the maintenance, changing spark plugs, etc., etc. If the market figures out a way where we're not all riding on thousands of pounds of lithium, then I would say I'm all in. And I think we're getting closer. Maybe there's some sort of charging mechanism that charges way faster than what they've got going on right now. Maybe it's a capacitor. I don't know. And maybe the cars will be just as light as our ICE vehicles, but with electric engines. I would love that. I just don't think we're there yet. I think it's very early. And I don't think that the disruption to the oil market will be significant enough to stop the current bull market that we're in. But maybe 10 or 20 years from now, yeah, he's probably right. Probably right. A lot more of these vehicles will be on the roads. And I also think ICE vehicles will be on the roads too, and hybrids and a whole bunch of other things. Platinum, this is the $900 major level held again. Not the big levels to pass are $1,000 and $1,130 that are ahead of us. It does look like we've got some sort of inverted head and shoulder deal going on. I think precious metals in general will go up when the yield curve uninverts and it gets you that big tailwind behind it. So dollar would go down, DXY specifically, and the yield curve starts to uninvert. This is going to rocket launch platinum, silver, gold, all the precious metals. The tightening financial conditions illustrated in one chart. U.S. housing payment for new homes is now as high as 51% of the median household income. That is the highest level since the 1980s. So that is definitely true. One could also kind of look at this chart here, and it's almost like all of the commodity companies have the same chart here. It's the same chart specifically. You can see the large 40-year decline in this movement is the same as the interest rates. So if I were to yank up the 10-year interest rates, so the interest rates are exactly the same as this U.S. new home payment as percent of income chart. It's the same exact chart, verbatim. The Federal Reserve doesn't run this. They don't run new home payments as a percent of income necessarily. The markets are doing that. And obviously they state that they're going to do this, but the market is forcing them to do it. Bondholders are selling their bonds. They're not stepping in and going to buy it and try to manipulate the markets, at least not yet. So this is just a function of the commodity bull markets are a function of, you could say, U.S. new home payment as a percent of income. So if this continues to go up, I would expect commodities to go up, as weird as that sounds. Another thing, this here is also a function of how short we are in the housing market of homes. It is also that function. Scrolling down, we've got Uranium, The uranium mining companies, big breakouts here. Long-term golden trend lines taken out. That's that big guy here. Also the 6-month neckline of that inverted head and shoulders, shoulder, head, shoulder, breaking to the upside. This is a confluence of events all coming together and break into upside for Uranium. So this is Uranium versus um, the uranium futures pricing, and it's breaking out right now. So everything looks really good for uranium, and hopefully we get a big push here, the upside for uranium and all the holders. Grady says that's a huge purple bull flag and backtest for the big dog precious metals royalty company Wheaton. Wheaton is a sector leader, so what it does is important, and pink backtest is holding so far. Yeah, shoulder head shoulder breakout, another flag pattern, and we're sitting on top of it just like gold. It has the same pattern as gold, basically. Brady says, think many of established correlations will change with what's coming. Also think there are too many macro parameters nowadays for much of traditional macro analysis to be useful. It means that the firms usually are using mainly algos, regression, old correlations will start to mislead clients. And one of those things that has a big divergence is TLT, which is bond prices in relationship to the gold price. Very large divergence there. Imagine a small neighborhood with just 10 houses. The prices of the houses are stable as there's a balance between supply and demand. Now imagine if suddenly everyone in the town was given a lot more money to buy houses at the same neighborhood. The amount of money everyone has increased, but the number of houses remain the same at 10. The logical rules of economics have changed. This is the M2 money supply going on up. And then this is your M2 and trillions here going on up. What he's saying is there's just a bunch more money in the system, and the real estate price is just adjusted for all that money that was in the system. One thing that I will say here is it's not just that. What's I think happening is there's a lot more money in the system, which does impact asset prices. Money starts to flow differently as well under those market conditions. If there is a shortage in housing, which I think there is a deficit in housing, then you're going to have the medium income people get priced out of the market because they have to. So now you're dealing with people who have more money, who have more assets. And if a bunch of money was printed before it, their asset values will go up as well. So not only are they richer, they also have more money, more income, more dividends, more all this other stuff. And you're competing against those people who have the assets. It's not against the 40th or 50th percentile of wealth. Those guys are getting priced out at this point, in my opinion. So it's the combination of all that stuff, of what he's described. You give everybody a bunch of money, then if there is a shortage in the housing market, it's going to be amplified amongst the people who do have money, but they have a lot more money, not just the increase that was paid out. All their asset values went up too. Coming on down here, market sentiment has to be at extremes at major tops bullish and bottoms bearish for a turn to happen. Phrased differently, most has to be on the wrong side for big moves to start. Be on the right side, join us at the service. Gold is now back above the blue line intra-month. It's sitting on top of that pattern. And we're going to get liftoff at some point when the market conditions are right for that to get liftoff. And this is a shoulder with a handle, or a cup and handle pattern, I mean. So Wheaton Precious Metals has the same exact chart as gold. I mean, it's literally sitting at the same spot. It's just one big leverage play to gold. And gold, he's in a great location. Silver is also in a great location. I'll show you the charts in silver coming up here. There's a bunch that are aligned very, very well. We do not need oil to trade any higher for oil companies to be doing very well. One mid-cap oil sand company at the current oil price is free cash flowing 3.2 million every day, enough to buy back 21% of their shares outstanding. Any higher oil price is simply gravy. And that's the cash flow game that I want people to focus on, especially on our website, base cash flows. They don't need prices to go up. If they have this cash flow coming in, they can buy back their shares, reduce the share count, and then give it back to you in dividends. Would you like a 10 or 20% dividend? I sure would. I'll take it. The companies are working and progressing towards that big dividend payout eventually. What they're going to do is pay down their debt. That's step number one. Step number two is buy back shares if they think their company is undervalued. So they're going to buy back all their shares. Number three, take the cash flow after they've bought back all their shares and they think that the price is high enough and it's fairly valued, they're going to return cash to shareholders. That is the majority of the plans of a lot of these cash flowing companies. And hopefully they execute and they do well. Possibly the most important technical chart for precious metals investors today. Silver is less than 3% away from a major breakout from a 12-year resistance line. Following an extended period of consolidation, the metal is poised for a rigorous rally to revisit its highs from 2011. As gold stands on the verge of breaking through a triple top formation and initiating another secular move, it's crucial to bear in mind that silver at its current prices appears exceptionally attractive and is likely to take the lead in this long-term cycle. There's also another gigantic pattern. If you go all the way back to the 1970s, it's a big cup that comes up, and this is the handle that's forming, and we're about to break that handle to the upside. If you look at it from a logarithmic perspective, you could see silver go to just astronomical levels, $700, $600, some ridiculous level, which is pretty cool. But we're at that point at the starting grid, and we're all lined up. The gun hasn't shot yet, but it's basically gonna shoot out the hole here. We're right there waiting to break here. Again, here's another chart from a little bit different viewpoint. Silver had a perfect back test to triple support at 19 level. Now right up against the blue line again. Blue mega triangle trend line has had many hits, so should give way soon. Note that the false breakout's already done, so this is the false breakout in 2020. We came up and we're ramming against this trend line. That trend line has so many sellers. Once we break down those sellers, the race is on. The gun is shot. Annual dividend income. I wanted to cover this. You can see, $114 all the way till $3,500. That's 11 years of growth for the dividend income. It starts to snowball. You can see 114, 186, 280. Not that impressive in the beginning, but if you start looking down here, these are going up in almost, $1,000 increments almost. Close to $1,000 increments. And that is a snowball where your dividend income starts to snowball higher and starts to go up at a steeper rate. Your trend line is steepening the rise over run. That's what happens, and that's called the snowball effect. Now, this can obviously go up far quicker than this. If you put more money into the investments and you have higher dividend yields. So I think that we can accelerate this, and that's what some of us are doing on the website. I'm taking high dividend paying companies that I think are undervalued, that have really good chart patterns that are breaking to the upside. So I think that you're going to see dividend growth with the price of the commodities alongside stock price appreciation. So we can construct an entire portfolio or a portion of a portfolio for dividend income. And that dividend income can snowball you forward. And a way that you can snowball forward is obviously putting more money into it, investing more over time, or having the commodity price go up and your dividend yields go up on your original purchase price. That can definitely snowball in your favor. But it's a very good way to increase your income. We have deeply inverted yield curve, which reflects pessimism about the economic outlook. The yield curve has inverted 8 times since World War II, and each time it has preceded a recession by an average of 18 months. The most recent current inversion in March of 2022, which means that the recession could be on the horizon. When the yield curve inverts, it means that investors are more worried about the short-term economic outlook than the long-term economic outlook. I disagree with this, but the yield curve occurs when the 3-year month treasury exceeds the 10-year. Couple things. It's not pessimism about the economic outlook. That's not why the curve inverts. And it's not about that they're more worried about the short-term economic outlook than the long term. That's not necessarily the case. The yield curve inverts because of the real estate market and inflation and then when the driver of the inflation starts to fall apart, the yield curve uninverts, and then when it starts to uninvert at a faster pace, there's usually a recession. So it'll invert, and then when it starts to uninvert, you usually get a recession. So if you look, it's coming on up, we get a recession. 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 Each time this thing's bottomed and started to come back up, we get a recession. We're at a very low level. We don't know how long it's going to stay down there. And it could come back up for a variety of reasons. It may not be the real estate market that drives it. We've gotten the 2000 dot-com bubble was not driven by real estate. The rest on this were driven by real estate market crashes. So the inversion of the yield curve is a function of inflation in the system. That inflation interacts with the bond market, which really causes selling pressure in the short end of the curve, which raises yields up on the short end faster than the long end. And that is where everything kind of inverts. When that inflation is done, the yield curve will come back up if there's some sort of problem in the market. Interest rates, if there is a problem in the market, interest rates will eventually fall and come back down. So what you'll generally see is if it's from the housing market, you'll see a lot of inventory of homes, which we don't have. You'll see a housing market in a huge hyper supply phase. It's an expansion phase of real estate, which we don't have. We're in an expansion phase. We're not in a hyper supply phase yet. And that will all unwind if it's coming from the housing market. And there'll be a deleveraging event in the market where credit is destroyed. The dot-com bubble wasn't really like that. And we could get something like the dot-com bubble. It's possible. But at this time, it just doesn't look like we're coming up enough with yields yet. And when that yield comes back up, when it comes back up from this, precious metals go ballistic. That's when precious metals do very well. 2000, 2001, that's when precious metals did very well. Back in 2009, precious metals did well all the way to 2011. Right now, we're at very low level. And precious metals are a good spot to look, in my opinion. Zillow says 7.5% mortgage rates won't halt home price growth. Wait. Let me read that again, guys. 7.5% mortgage rates will not halt home price growth. Zillow is a full-blown housing bull forecasting that U.S. home prices will rise 6.5% between July 2023 and July 2024. Zillow expects Miami to jump 8.4%. So that's what they are predicting. I think that's pretty interesting. Am I in their camp? I could see it. I could see home prices go up even though that mortgage rates are high. I think there's a psychological factor to it, and I do think there's a shortage of homes. How high it will go, I don't know. I don't know. We're in the thick of a housing market bull market. Previous bull markets, the rise of interest rates did not stop the real estate cycle. It slowed it down during times. It's slowed it down, but it hasn't completely stopped it historically. What has stopped the housing market bull cycles has been a increase of inventory, an overbuilding state. We go into a hyper supply phase and then everything crashes. We generally have foreclosures too that increase towards the end of the market. Right now, we don't have any of that. We have none of that. And I would say Zillow is closer to being right than someone who's predicting a 20% housing market crash. But that's my opinion. The housing market has been deteriorating rapidly. Here's another different viewpoint. Existing home sales have plummeted. For home sales to recover, the Fed has to typically needed to cut rates. Now, here's the thing. All of these downward movements were housing market crashes, but were preceded, that market crash was preceded by ridiculously high inventory levels. We also had ridiculously high new home builds. We don't have any of those right now. So this one is nullified. Like we don't have the same market conditions. We don't have the same market conditions. We don't have the same market conditions in 1990. We don't have the same market conditions as here. The only time we do is maybe this one. That is it. But existing home sales, if you notice, were continuing to go up during that time frame. And right now, home sales have declined, but our inventory levels have remained very low. We have a very weird situation going on in the housing market at this time. It does not meet any of these other previous sessions, basically. So it's a very weird movement, and that's what I'll say there. Troubles brewing in the housing market as mortgage applications in the U.S. plunged to 28-year lows. This is dealing with the affordability. So I've got two stark contrasts of the housing market, so you guys can have both, both sides of the story here. These guys think it's going to go lower. Zillow thinks it's going to rocket on higher. And I just want to show the two differences. Invest. So this is in 2022. Terry Smith gave a brilliant interview with Economic Times. Smith promotes buying good companies, don't overpay, do nothing. Oh, that's kind of interesting. I always say do nothing. And then he's got 14 key takeaways from the interview that I won't dive deep into. But the do nothing part, I think, is the hardest for most people. You can find a good company, you can find it at a very good price at some point in the market, but doing nothing is the hardest, because if it's not doing something in a time frame that people deem that it should be doing something, they generally get bored with it and sell it. So here are some. Construction starts in China at the lowest level since 2010. There is no meaningful economic recovery happening yet. They went through a housing bubble. They are in a recovery phase, and they're underbuilding right now because they built too much. They built too much in their system. Their demographic also declined. They are 100% in a housing market bust. They're in a recovery phase. They just started the recovery phase maybe last year, and they're going to have to go through a recovery phase of real estate. During that time, generally tech stocks do very well. And with the market conditions we have over here, I think that we could see maybe some of these Chinese tech companies do quite well. He says, maybe it's time for real assets to perform again. And we've got a bottom here in 2020 starting to come on up. You can see that we are at very low levels compared to history. We have been financialized. And I think what's going to happen is real assets will start to outperform financial assets in relative price. And that's what I've got for today, guys. So if you guys enjoyed the clip, give me a thumb up, subscribe to the channel, subscribe to the website if you like. We do have that 50% discount. September is the coupon code for the monthly sign up. And that's all I've got. So hopefully you guys are doing well. We'll catch you next time. Finding value.